Well, welcome back, everybody. My name's Giles. I'm the economics editor at the Financial Times, and it's my real pleasure to have you staying on for the final session for a panel on future directions for research in intangible assets. And I think we've got a great panel here who I think I'm going to learn a lot. And I think there's one thing in a room of researchers that we can all agree on, which is that more research is needed. So from now on, that's a banned phrase, particularly to the panel. But let me just introduce everyone very briefly. To my immediate right is Tera Allas from McKinsey, then Richard Hayes from the Office for National Statistics, and then on my far right is Stian Westlake from the Royal Statistical Society, and hopefully beaming in from the US, we have Rachel Soloveichik from the US Bureau of Economic Analysis, who's there. Hi, Rachel. Very good to see you. And she can hear us as well, even better. So without more ado, I think we're going to go in that order. The slides are loaded, so hopefully when people click on the button, the correct slide will come up, and Tera, the floor is yours.
Thank you very much. And first of all, thank you so much for inviting me to be here on the panel. I hope you've had a good 2 days of discussions and, sharing research and findings and analysis, and indeed all those requests for further research. Obviously, what I'm going to share with you is very much a subjective perspective. And, given my role, a lot of the questions that we're asking are really about what drives firm level performance, but also then what drives productivity at the kind of aggregate economy level, and potentially, what might be some of the policy implications of answers to those questions. Now, it goes without saying that if some of the stuff that I raise as a priority is stuff that actually already exists, then the priority is dissemination, communication, and diffusion, because I didn't know about it. I'm not saying I'm unique in any way. There's probably lots of people who don't know everything there is to know, but I do also kind of in general very much encourage dissemination, communication, and diffusion, because that's actually where we get the value from ultimately in research. So with that kind of context, I have 5 proposals for priorities, which for each of those, I'm kind of going to illustrate what we already have, which is fantastic, helpful, and useful, but what might be the kind of next step, or where would be useful to have even more. Because the glasses I'm wearing, I can't actually read my own slides, so we'll have to just assume that I remember from memory what I'm going to be talking about. So starting off with comparability, it's really helpful from a kind of an analytical perspective to be able to compare things between countries in particular. So it's wonderful that we already have data from the IntanNet database, but also from EU CLEMS about the investment in the different types of assets, whether they be tangible or intangible, by country and by sector. And so, for example, for the UK, that allows us to find that, we spend as an economy quite a bit less on R&D and quite a bit less on I can't see what my first column is, but whatever, I'm kind of thinking software, yes. And we spend quite a lot more on things like branding, marketing, organizational capital. Now, as we say, double click on that, you do, of course, need to understand what's underneath it, because this is very, very driven by the industrial structure of your country. So if you have a lot of manufacturing that's super advanced, then you're going to get a lot of R&D investment. Similarly, you don't get a lot of mineral exploration if you don't have any minerals to explore. So the good news is that we do have that data. The bad news is the question on the top right-hand side is, well, this is data for 2015. It would be really, really nice to have data for 2019, for example, or even 2020. And, these sort of historical comparable statistics obviously take time to compile, but, the more we can make it a little bit more up to date, the better. The great news is that in the UK, if we then put aside the kind of international comparison, we do have this data for 2020. And so all I've done on this chart is just kind of plot it, because I thought it was really interesting to see, well, what did happen in 2020, the year or first year of the pandemic? And I haven't shown all of the different asset classes. And obviously we do not have this data for the non-capitalized intangibles that are not in national accounts, but we do have it for R&D and for software. And very interestingly, actually, both R&D and software investment in many sectors, those sectors that are big investors in them, including manufacturing, education for R&D, that probably essentially is universities. And then, financial services, professional services, and so on for software. They actually kept going up at quite a rate last year. Whereas we saw big drops in investment in more tangible assets. This is kind of what you would expect, but because I'm generally speaking a bit of a productivity pessimist, I think for me, this gives me some hope that actually maybe I'm being overly pessimistic. Sadly, of course, this doesn't show us the other intangibles that we'd be super interested in. What happened to management, what happened to training, what happened to all those things. There are some indicators out there that are also, by the way, are relatively speaking quite positive in terms of investment that continued to go into intangibles last year. But it would be great to see that alongside the kind of stuff that's in national accounts. And then there are softer aspects of intangibles that I think need either embedding into some of the management stuff or need to be looked at separately. So this is a chart that comes from a piece of work we did, which was called the boss factor. Basically, showing that, first of all, staff engagement, however you measure it, has an enormous impact on productivity at the firm level. Its impact on productivity, by the way, first of all, I do not know about causality. I'll come on to it. These are mostly based on correlations, not causality, but trying to control for all kinds of other variables. So indicative of some causal relationship. But basically, when you have better staff engagement, which is essentially a kind of social capital inside a firm, you get better results. Your customers are happier, people don't leave as much, basically you get better productivity performance. And a lot of this is driven not by pay or by conditions or kind of some of the more traditional things people think about when they think about how to keep their staff happy. Very driven by social relationships, and especially people's relationship with their boss. And so if this is so important for staff engagement, if staff engagement is really important for firm level profitability and performance and growth, then, I wish there was some way we could more actively and more systematically measure it as well. Of course, it doesn't help if that's the only asset you have. If the only asset is in your firm that your staff is happy, well, unlikely to deliver a lot of bottom line improvements. And so the next bit, which I think is really important, and I know there is a lot of research already on, is around the complementarity of these different types of investments and assets. And this is just one example based on the Intannet and EU-CLEMS data, and really just throwing it all into machine learning model and asking what maximizes productivity growth across all the European countries that are in the database and all the sectors that are in the database. And the point of this chart is really just to illustrate that there's a lot of non-linearities there. The bigger point is the question in the right-hand corner, which is, doing this per segment, sector per country is not really what you want to be doing. You want to be doing it using firm level data that's much more granular and where you can control for all kinds of other reasons why these things might have grown faster or slower. And that really brings me to my final point, which is you can tease out from this kind of analysis what the most important drivers or predictors, not drivers in a causal sense, are of productivity growth. And no surprise, R&D, organizational capital, all of these things are very important. And you can start also understanding some aspects of the UK's productivity puzzle, because in some of these areas we invest more and in some of them we invest less, or our assets are less or more, depending on how you want to look at it. I think either way you get very similar results, but doesn't really tell us anything about causality. I think, you know, one of the things where firm level data combined with kind of good theoretical thinking combined with new metrics is going to be really powerful, as if we can get more into the causality discussion. And really, I know my slides are full of causal language where they shouldn't be, because it's just so easy to slip into talking about this means that, and, you know, this drives whatever. But truthfully, we don't really know a lot about that stuff unless we get much more granular with our analysis. So that's really just a summary of what I think would be really interesting areas to build on, because we have fantastic stuff already, thanks to all of you guys in this room and various other people who've invested in it. But there's still quite a lot of questions to be answered.
Lovely.
Thank you.
Thank you very much, Tera. And now we're on to Richard.
Okay, so I'm going to talk a little bit about data as an intangible asset. So over the last couple of years, I've been on the SNA digitalization task team looking at revision to the SNA.
System of National Accounts.
System of National Accounts.
One or two people who don't know in this one.
And just to say, obviously, in that context, a lot of what I'm going to say are my views, not necessarily views of the ONS, but I also want to thank people like Marshall and Carol, who've been on the working group alongside me. I'm going to give, in short, a brief report back on some of the things we've done, and not really talk about necessarily research we need to do, but more testing and implementation. Because one of the areas that we have been exploring is looking at data as an asset, bringing data as a new intangible into the system of national accounts. And it's probably worth saying a little bit, why did we pick data, not branding or organizational capital or any of these other parts of the framework that we've been discussing over the last couple of days? And it's mainly because data is in a very odd position of being both in and out. So where data comes in, we don't currently capture the acquisition of data, but if data is held in a database and that database is then sold, it is captured. So it's in this sort of a halfway house position. So we felt rather than starting a new topic, we'd finish an old one. So around this, and I'm going to very much put my hands up and say I've stolen this diagram quite shamelessly from John Mitchell at the OECD. We're very much thinking about data being added to the framework between the world of, I'm going to introduce some jargon and put it out there so people start getting used to it, observable phenomena and databases which are already captured. And essentially the work we've been doing is looking at how we can put a value on data which is distinct from what we might call observable phenomena. So Stian has arrived in a white shirt. This is an observable phenomenon. Until someone writes it down or puts this into a bit of computer database, it's not really of any great value to anybody. But for someone who's selling white shirts, this becomes very useful information on who to target their sales towards. And so trying to move from identifying correctly what's an observable phenomena into what we can actually legitimately class as data is really important. So a lot of the work has been focusing on trying to get the definitions of the concepts correct, but equally trying to make sure that in terms of thinking about how we value data, that we're correctly thinking about this process. And particularly what costs you want to include when you're thinking about the costs of creating this data. And probably the easiest way to think about this is something like Google or Facebook. This is a piece of software which goes away and provides us with a service, and at the same time is harvesting and recording OP into data. So what part of that vast cost of the Google software does one want to capture? Because if one decides to capitalize all of that as a data acquisition input, one's going to end up with a very, very big value of data very, very quickly and possibly quite erroneously. So we've been exploring three basic scenarios through which firms can acquire OPs and record them into data, either in exchange for free services like the social media or Google example. Sometimes they pay for them. That one's remarkably easy. We think we can cope with that. Or as a byproduct of the primary production, sort of in effect, own production data costs. Now around these, effectively, there's a degree to which we may need to impute or calculate some fraction of the value. And that obviously is where we're going to need, over the next few months, we're going to release, as part of the UN's process, consultation guidance notes for countries to take hold of, to implement, to attempt to implement, to test, and to see how the framework works and how it delivers. But just to go back to this picture, the really big challenge that I think amongst what we've been dealing with, there are a number of challenges, but probably one of the first, which this picture makes very clear, is where does data end in databases, which is an asset which is already in national accounts. Where does one end, where does one begin? And in many ways, listening to the conversations over the last couple of days, where we've talked about software, databases, data, and even some artistic originals such as computer games, where do these all stop and start? In a measurement sense is going to be a real challenge. And to a degree, whilst analytically it may have great value for us to be able to differentiate these, for many countries in the measurement sense, we may need to be thinking about bringing these closer together. Diane's paper earlier today talked a lot about different methods for attempting to measure these, and you'll see much of that reflected in the guidance note. But before I sort of move off of this and pass on to Stian, I wanted to sort of also reflect on what that overall SNA revision process has got me thinking about, because in effect, at the moment, we're organized very much on themes. We have a theme on globalization, a theme on digitalization, and a theme on well-being and sustainability. But actually, when you look across the piece of these three areas of work, these three programs of work, the thing which is common across them is the challenge of thinking about capital, and particularly capitals that don't fit very comfortably into the accepted framework. And we already see this really matters. Hugo's paper earlier today showed us that if we think about databases and data analytics, half the value he was estimating came from the data. That's outside the national accounts. But we also know from Jonathan's paper just a few minutes ago that intangibles already exceed tangibles within the national accounts framework. So very much we're in a world where tangibles, which shape and guide the way we think about how we classify and measure capital, are the smallest part of what we already capture in the national accounts, and outside the national accounts, we know we're missing a large number of very significant items. And in essence, if you look at where we're starting from, SNA 2008 is essentially an artifact of a pre-digital age. It is a document that only mentions digital 2 or 3 times, and each of those are in relation to that fantastic innovation, the digital camera, something which has already been superseded by mobile phones for the vast majority of users. Very much as I look at 2025, I think we do need to go through a process of consolidating our thinking, because many of the challenges each of the task teams are facing are ones that we've discussed today about intangibles, but very much across that spread of capital assets. So we've talked about challenges around thinking about ownership. So intangibles are a non-rival product. Thinking about who owns them in a national account sense is very, very important. But in some way, everyone who uses a piece of open access software is to some degree owning it. That is exactly the same problem for atmosphere. It's exactly the same problem for human capital. Do I own my human capital? Does my employer own my human capital? These are fundamental questions. Non-produced, produced, the differentiation that we have within the national accounts between assets which are produced by humans, those assets which are produced, non-produced, which come from the environment and so on. This is looking at Peter van der Ven's papers on the environment. I know this is an area he's finding a lot of challenge thinking about how to conceptualize some of the key elements of the environment and thinking about natural capital in terms of this produced, non-produced boundary. And finally, the sort of non-rival components of a lot of these products, I think, are going to drive us to need to think a little bit, because ultimately, when we're thinking about the SNA, we have a choice for any of these border cases. You can bend the asset a little bit to fit with the existing treatments and the existing definitions, or you can ultimately think about how you reshape some of the concepts within the SNA. My feeling is that we're at the tipping point in SNA25, where the pressure to begin to stop bending assets to fit within the existing model is running into this tension of whether we need to recast some of these fundamental ways of thinking about capital. Whether SNA25 will quite deliver that, I think, is both not clear, but also not as important as it's historically been, because one of the aims is for the next version of the SNA to be more of a living document with more supporting guidance that can change and flex more than once in a generation. Because I think that ultimately is something we need as a measurement and research community to be able to adapt more quickly in a world where these things are moving a lot faster than historically.
Thank you very much, Richard. Can I just, before we move on to Rachel, can I ask one very quick question? It's the SNA25. Sorry, it's a journalistic question. When will that have an effect on the National Accounts? And roughly, if it goes in the direction you're thinking, what effect will it be?
So, using SNA08 as an example, in the past, the UK implemented the European version, which came out in 2010. And so around 2012, 2013, we were able to fully implement those changes. This time, there is a degree to which countries will be doing more testing in advance through satellite accounts and further supplementary tables. So that may shortcut some of the process, but some of the changes are likely to be quite significant. So I'd say probably that sort of 2 to 3 year time lag would be
the end of the decade-ish.
End of the decade-ish, I would think. But importantly, those supplementary tables will be available in the run into that time period. So hopefully people will get the opportunity to interrogate those and pass feedback back to their NSIs and the UN.
And the effect?
That's a very good question. There's 150 guidance notes. I've not managed to read all of them yet, so I can't yet tell you what I think the aggregate effect will be, I'm afraid.
Fine. Thank you, Richard. Now, hopefully we can beam over to the US and hand over to Rachel.
Thank you so much for having me remotely. I'm going to do one of the fun thing of panelists, which is give people ideas of a lot of work to do. And just if you go to the next slide, here are some things intangible that I think are worth studying. Next slide, please. Next. Thank you. So here we've had a great thing in which people have been talking about a lot of wonderful intangible capital. I'm all in favor of putting them in the accounts. I like GDP to be large, but I think there's still other categories of intangible capital that are big and economically important, but have not yet been talked about. So the first one, and that one I have much better numbers on than the others, is natural resource exploitation. And just to review for people not familiar with the System of National Accounts 2008, which I'll call SNA 2008, we track mineral exploration. If I have a beautiful mountain and I strip mine it for coal, so all of my research on where the coal is and how I can strip mine it most effectively, that's investment. But if I put up a ski slope so that people can enjoy it sustainably, all my research figuring out where's the best ski slopes, where the beginners should go, where the experienced people should go, where the resort should be, that's not tracked as capital. And so it's implicitly bundled with the natural resource. And that's not so bad if all your goal was to measure wealth, because here's the market price for this beautiful mountain. But if you want to measure how did it arise, was it non-produced natural resource? Was it investment? And some of this might be in other types of intangible capital. People have been talking a lot about data. So the ski company uses a very data-driven approach where they get a seismologist who, gets a huge data set. So maybe that data is part of the value of the ski slope, but if they do a less formal approach, and so I'm proposing let's track all explorations in tangible capital. So the second thing is household production knowledge. The third is disease fighting information. Next slide, please. So here's just an example of how important exploration can be. This is a map of the United States in the early 1800s, and the pink territory cost about 43 cents an acre. And at that time, the yellow territory, you could buy unimproved land, similar quality. If you know the US geography, there's a lot of good states in the pink area. So this wasn't like people were getting low quality land for cheap. It was just they knew it was land, they knew approximately how big it was, but they had no idea what was in there, and so you didn't know how to use it. And it costs a lot of time and resources to figure out how to use it. Next slide, please. And so this is just intangible exploration capital, a share of natural resource value. And the exact numbers are less important than the fact that they're a pretty big share. And the reason they went down in the 70s was basically because natural resource prices went up for a lot of different reasons. There's a share of GDP, it's much smoother. So what we think is the most tangible possible thing, land that can't move and, is easy collateral for everybody. It turns out that it's really a good portion of it's intangible. Because if you just got handed a random piece of land and nobody told you anything about it, it would be nearly useless. And of course, the bank's not so worried about repossessing the knowledge because it's often written down. And even if the person refuses to divulge it, they don't get to keep it because it's a treasure map. If you don't have the land, you can't use the treasure map. And so I'd like to see this valued as an intangible. So next slide, please. And here's just what happens to asset quantities. Natural resources go up faster because we're investing steadily in, improving natural resources in ways we thought they were the same, but now they're better because we know what to do with them. Next slide, please. So this one is much more speculative. If you haven't been watching TV in the past decade, this is Downton Abbey, which shows everything that you need to run a well-functioning household. And so you can just sort of see, here are all the tasks that people can do. And it doesn't even show the family who also don't seem to do some household production. And so ordinary households, one person does all of these different tasks. But when we measure household production, we're getting the blue tax. That's done by the low skill people. Yes, you might notice they're women. It's a very sexist era. And then the higher skilled era, the management, the social planning, they tend to be done by the higher paid people who we just don't capture it. If we don't have the time use surveys, we might have cooking the meal. We don't necessarily have the person who decides how to place people at the dinner and then when each course should be served and trying to, manage so people don't talk about awkward topics. But these are big things. And we're going to talk about organizational capital in firms. We might want to think about how we can measure it in households. Next slide, please. And finally, this is, of course, inspired by the past few years. Everybody talks about, information stored in the brain. And these are important things of information. I'm obviously in favor of the brain. As economists, we tend to like it. But there's another part of the body that stores information, that learns and responds to the environment too. And so we have all these different types of immunity that's learned, that our immune system knows. And if we wanted to think about, what the brain knows, we should also think about what the immune system knows, especially now with human capital. It's not just R&D to find a vaccine, it's actually getting it into arms around the world. And that's not a trivial thing. And we might want to study, here's the human capital. People took a big jump in the past years. They were being vaccinated around the world. So thank you very much for letting me talk about the things I want to study in the future, and I'll give it over to the next presenter.
Thank you very much, Rachel. And hopefully when we get to the Q&A, we can see if we can sort out the sound from the US. Maybe she. Okay, well,
I'm sorry, were people not able to hear me when I was talking?
Rachel, we were able to hear you. It's just it was a bit crackly, that was all. So we got it all, but it was just, if we can improve it, that would be even better. Stian, I'll turn it to you.
Try logging on and off.
Click forward.
Yeah.
Thank you very much. It's great to be here with such a distinguished community of intangibles researchers. And because of that, I would not have the temerity to tell you what you should be researching in the future. But what I wanted to talk about from my policy experience was what almost some of the policy reasons why this agenda is so important, which might provide some guidance for useful inquiries to look at. And I guess I start from this point of view with what Jonathan and I call the 4 S's, these kind of economic characteristics of intangibles, which you'll all, I'm sure, be familiar with. Scalability, the fact that a bit of intangibles goes an arbitrarily long way. Spillovers, the fact that it's hard to appropriate the benefits of intangibles. Sunkenness, the fact that it is often hard to get the benefit of investments if a firm goes bust. And synergies, the fact that these intangibles are often very valuable when they go together. And as many of us have argued, these create a very different type of economy if these type of intangibles are dominant. And there's a few things that I think are particularly relevant for policymakers at the moment. So the first challenge is the challenge of how do you manage spillovers? In an economy where more and more of your capital stock exhibits spillovers, how do you deal with that? And if you start with the left-hand side, clearly spillovers are not exactly a new economic problem. The Canaro paper talking about spillovers of R&D is 50 years old this year, been known about for even longer than that. But clearly there is a problem. If we have more spillovers, we might have a greater underinvestment problem if we rely on private markets to do this investment. So this leads to a number of really salient problems for policymakers. The first question is, what do we do about public investment if we're expecting to top up these stocks of investment in R&D or education or whatever? The second question, which is something I've been obsessed about for a while, is the question of how heterogeneous is intangible capital. So when we deal with tangible capital, to a certain extent, we expect this stuff is traded in free markets. The absolute volume of your physical capital stock is kind of what matters. You expect there'll be some bad investments, some good investments, but it'll balance out. But there is a question that perhaps intangible capital is more heterogeneous in a kind of Lachman sense, that some intangible investments are just really, really good, and a lot of them are really, really bad. We'll talk about what that means, implications in a second. And then finally, a question of whether we can use digital technologies to constrain some of these spillovers. And that leads to kind of 3 of these sort of policy debates that you get on the right-hand side. So most OECD countries have been aggressively trying to increase the amount of R&D that they publicly fund, certainly a big issue in the UK with a 2.5% R&D target. It also drives some of these questions like the open data agenda. If we look back, say, 15, 20 years ago, in UK policy, the agenda for what to do with government data was how can you monetize it? So you'd see the agenda where the Ordnance Survey, our mapping company, would try and sell its data. Over the last 15 years, that's kind of moved a little bit, and there's now this realization that, well, actually, maybe things like government provided data are public goods that we should be providing more. So 2 hot topics there. This heterogeneous capital question, I think, lies at the center of a lot of the debate on innovation policy, which always fascinates me. Those of you familiar with Mariana Mazzucato's work will be very aware of this concept of mission-oriented innovation, that it's not just important to spend lots of public money on innovation, but there are some investments, whether those are related to climate change or other areas, that are just so good that the guiding hand of the government should focus on those kind of things. But this isn't just an idea that you see on the left. If you look at kind of Dominic Cummings' particularly passion project, ARIA, the kind of UK version of ARPA, that is absolutely driven by exactly the same kind of idea, that some R&D investments are just so transformative that it is worth significantly changing the structure of how we make public investments in the hope that we can discover them. Similarly, we find this, if you look at the debate, which I certainly was very involved in the policy world, about the idea that lots of higher education is wasteful, this idea that we've got too many indiscriminate university degrees, that is very much sort of underpinned by this idea that intangible capital, some intangible capital is good, some intangible capital is bad. And the move that we've got from a world where, say in around 2000, we just wanted to increase the amount of tertiary education going on, to a world now where a lot of policymakers, rightly or wrongly, are obsessed with this idea that some university education is wasteful, that some degrees are low value. That seems to me to be a reflection of this awareness of the heterogeneity of capital. And then finally, this idea of tech being used to constrain spillovers. To me, this helps explain a lot of the agenda in innovation in blockchain. So you'll all be familiar with non-fungible tokens, this sort of slightly strange way that people claim to be able to buy material interest in an artwork because they'll own a registry on it on the blockchain somewhere. It feels to me that all of this is an attempt to say we're in an economy where spillovers are sort of super abundant, they're more and more important. Can we use, in this case, blockchain technology to try and mitigate that? I'm not an NFT fan myself, but I kind of can see where the desire comes from to do that and why that might be more common. The second question, which is something Jonathan alluded to, is this question of financial architecture. If we're in a world of sunkenness where bank lending is potentially less appropriate, what do we do about that? How do we organize the proper capital development of society, especially in a world where the vast majority of businesses still rely on debt finance or external finance? This leads to a lot of questions in the middle there about how to allow more firms to access equity capital. Over the last 50 years, there was this kind of little revolution starting in California of venture capital, whereby a small group of companies that were very high growth gained access to this kind of wonderful form of primary equity. It's pretty clear that that's not appropriate for all businesses, but there's a question, well, how would you get more availability of equity finance to other businesses that might now want to be investing in intangible capital? We suspect that the unequal tax treatment of equity and debt is a big issue there, and equalizing that is obviously a great political labor if someone wants to look at it. I think in the UK, where our institutional investors are often very reluctant to invest in private equity, whether that's venture capital or of other sorts, there are some really interesting financial regulation questions of things like the Solvency II directive, the fact that we've got lots of relatively small, often defined benefit pension schemes in comparison to, say, somewhere like Canada, where you've got these enormous defined contribution schemes that seem to do lots of interesting investment. I think those are those are really interesting questions. One thing I found fascinating in government is it doesn't seem to be anyone's specific problem. I looked in the Treasury, I looked in our business department, I looked in the organizations that were responsible for equity finance. It's really hard to find anyone answering these or trying to ask these kind of financial architecture questions relating to equity. And I think this also ties into financial innovation. So it feels to me that there's been a kind of Cambrian explosion of new forms of finance, which to me are all trying to scratch that itch of how do you provide equity to non-venture capital accessible firms. But we look at SPACs, they're a kind of way of trying to provide that kind of liquidity. Crowdfunding, which I used to research at Nesta, a lot of very flaky practice in crowdfunding. But I suspect that the reason why this is such a big thing is that there is this need for equity finance, and that's one way of attempting to provide it. Similarly, a lot of the fintech developments. And then finally, something which I think is on all of our minds at the moment, what has happened to the kind of phenomenon that Ed Glazer described as the triumph of the city? We know that in a world of synergies and spillovers, cities will become more and more important. Agglomeration effects will get more and more powerful. But this is a huge issue for policymakers because we know whether it's in the Bay Area, whether it's London, whether it's many other places, planning massively restricts the ability to build in the most dynamic places. And that seems to be a pretty big issue if you want to develop an intangible economy. But at the same time, you've got lots of what in the UK get called left behind towns, places that have been left behind by these agglomeration effects. A huge political issue because all of these places in a geographical constituency model, they all have votes. And then finally, COVID has complicated all of this by throwing up the question, well, maybe distance might die. I think there's a kind of, this helps drive a lot of really important policy questions. Planning and zoning reform in the UK is a huge issue for the government. Current speculation that the government might have dropped its big planning reform plans, but this is, if we sort of think, what are the main aspects of current government economic policy, at least until recently, planning reform was going to have been one of them. So similarly, leveling up the idea of how do we generate economic growth in places that aren't benefiting from these agglomerations is certainly a hot topic in the UK at the moment. And then finally, I think this also helps explain why the debate around remote working, which feels like it ought to be quite a technocratic question, a question for business management, seems to have become a bit of a third rail of political debate, certainly in the UK. This is something that people are very ideologically exercised about. People have really strong views over and above their personal opinions about whether remote working is good or not. And I think this is probably something that is a result of the great importance of physical proximity in an intangible economy. It really matters if those rules have been broken and they can be replicated remotely. It really matters if the rules haven't been broken and remote working is going to cause a problem. And again, something that Paul and Jonathan's work is casting some really interesting light on. But this is something that kind of matters even more than you think it would. There are several other issues that are relevant that I won't go into: competition policy. We are not talking about monetary policy, and the question of how you deliver institutional reform. I felt my publishers would not let me get away if I didn't plug our new book, which tries to go into some of these questions. But I guess what the message from all of this is, what you're working on is super important. It's massively important for the policy world, and pushing these boundaries, doing the important technical research, will cast light on some of the most important questions of economic policy that governments in the UK and around the world are focused on.
Thank you very much, Stian. And I'm going to abuse my position as chair here, just to ask you a very quick question. But while I do, can everyone else start thinking about questions you want to ask and get ready, and don't be shy. We've got about 15 minutes left. Stian, I thought one of the things that you said, which was really, thank you, very interesting, was on one of your slides, you were talking about the city and planning reforms, and essentially saying that government was going to bottle it in some ways. And then in another of your slides, you had the whole issue of ARIA or ARPA, or the transformative role of government, potentially. Where does government failure fit into all of that? And is the former, the planning, does that say something about the latter?
I mean, this is a really good question, and obviously the challenge of both mission-oriented innovation and the idea that we can pick amazing R&D projects, that is a sort of government failure is the foil to that. And I think, there really is, I think there are a lot of questions to be asked, whether it's about ARIA or whether it's about setting innovation missions. Can government really do that? Certainly, having been on the inside of the sausage machine under the previous, the May government, looking at how we picked grand challenges, which was the kind of model of mission-oriented innovation. I mean, it was exactly what an economist would expect the process was like. It was lots of horse trading, lots of vested interest, the pharmaceutical lobby lobbying here, the automotive lobby lobbying there. What it didn't look like was very wise technocrats picking really great investment projects. So I think you're absolutely right to say government failure is a big issue. I think planning is another of these things that we have in the UK.
We sort of know what to do, but we don't do it.
We've got an incredibly powerful home voter lobby. I mean, it's partly generational, but there are a lot of votes to be lost by reforming planning, and I guess that's the other dimension of government failure. These are really hard problems to solve.
Okay, lovely. Thank you very much. And now questions to all of the panel, questions or comments. Don't be shy. Rachel, sorry, you're muted. I didn't hear you. Hopefully.
Can I make a comment about government planning? I don't want to say that sometimes zoning and all that is doesn't stop innovation, but sometimes it's just necessary exploration that if you're trying to do a complex project, you don't want to build in this area without knowing what endangered species are there that you might hurt. You don't want to, say, start a construction project without seeing if it's the right type of soil. Government, the rules exist for a reason, and so we shouldn't see them as only bad things.
No, I think that's a very good point, well made, and just reminds us all that trade-offs are literally everywhere. So any other questions for the panel? I'm not going to close it.
Chris, can I
No,
comment
Tera,
on
I
the
was gonna
government
say,
failure
yeah.
just very briefly, which is, I think as per what Stian's just said, really important to separate what is kind of lack of competence, let's put it that way, a sort of technocratic machine not working as effectively and efficiently as it could be, versus real life political economy constraints. And the second one, I think, has to exist in a democracy. Maybe we need to get smarter about how to deal with it. But, this is just the Juncker quote. We all know what needs to be done. We just don't know how to get re-elected if we do it. Yeah. And so somewhere the machinery needs to take that into account, and where things are better off with limited political interference, those then need to be set up as institutional, long-term setups where that's literally, the hands are tied for politicians.
Yeah, thank you, Tara. That's a very, very important, I think, very useful distinction, actually, those two. Jonathan.
Thanks, enjoyed the discussion. It's sort of the quality, synergies and the quality versus quantity sort of thing. So if I listen to Richard and if I listen to Rachel, we follow national accounts instructions, we count this asset up, and then Richard and Rachel have their committee meetings, we count the next asset up and the next asset up, and that leads you to the kind of more is better sort of notion that we're kind of counting all. Then we kind of add across the assets and we say, oh, the economy is a collection of all this stuff. And then Tara, to your thing, is that really what a sort of company is, if you sort of see what I mean? If we just add up its intangible assets in some way, are we able to get at the essence of what Google is or what LinkedIn is somehow? And somehow, this is, moving aside from the sort of national accounts side, it's that issue about whether it's more than the sum of the parts and the various ways in which we rightly or wrongly combine all this stuff together. So it's a puzzle. I'm sorry. So I make that, Chris, as a comment, not a solution, an offered solution.
So two comments on that. First of all, I think things can also be less than the sum of their parts. So this is very, very important, your point about heterogeneity. Like if you ask businesses and you go to the marketing department and they say, we're spending this amount of money on branding, the stereotypical marketing director will say, well, we know half of this is wasted, we just don't know which half. And this is absolutely a real life of business managers all the time making investments, which they hope will provide some returns, but actually really kind of provide those returns in a portfolio sense. So by and large, over some period of time across a number of different investments, they'll make a return. Or if they don't, they'll go out of business and then the economy will kind of take care of that portfolio part. So I think your point about adding to stuff up is really important. We do need to be very careful about how we think about the quality of stuff as well as the quantity of it, because certainly all of our research does not suggest more is always better. Sometimes less is better. And back to your point, if you just spent more money, even at the kind of whole economy level, if you spent more money on R&D, I don't know, in cancer research, but you spend zero money on diffusion of that knowledge, and you spend zero money on training the right engineers to build factories to deliver vaccines, et cetera, et cetera. Well, where does that money go? Well, it provides a spillover benefit to the world, which could be fine. We might be happy as taxpayers to provide that. But equally, we should then not kid ourselves. It'll show up somewhere in output or in productivity or in jobs or any of those other kind of more tangible things.
And,
Richard, do you want to?
Yeah, just to follow up. I think one of the challenges we face is that increasingly the capitals that we see in use have some of these increasing return to scale characteristics, which really doesn't fit within a nice linear national accounts framework. We are bending these assets away from the way they are to the way we would like them to be, to make them easy to count. And this is your classic national accounts trade-off. You've got to be able to feasibly count the damn things to do anything of any use, but sometimes you might have to creep a bit away from the concept you want to be able to do that. And it's a question of getting the balance right and how far, where is the tipping point before you actually have to start again and reshape some of your thinking. And that really is, I think, where particularly intangibles but also some of the natural capitals get us to a point of having to maybe start to think about taking a deep breath and diving into some of those debates.
What does it look? What does the economy look like, or what do the national accounts, rather than the economy? What do the national accounts look like if you do take that deep breath and dive in?
It's a very good question. I think one of the issues we have is there's lots and lots of different versions out there of how to go beyond GDP. Almost everybody has their own version of what beyond GDP should look like. I've got one. I published it on the ESCoE website. Do please look at it. But it is ultimately, I think, a really big question that we need to resolve, because statistics get their value from you being able to compare different countries, different time periods, and being able to see how things have changed and whether those changes are as good or not as good as others have achieved. And so it's almost one of these things that maybe sometimes you don't need to find the perfect option, you just need to agree on an option and go for it.
Yeah, I certainly would agree with that from a reporting perspective, because the one thing we want is some sort of uniformity, both over time and across countries. And I've always argued that we know what's wrong with GDP, and so we can find other ways of sorting some of those things out. Look, most people disagree with me about this. There's a question here.
Federal Reserve Bank of Philadelphia. So one issue about government innovation is that when the government produces a product according to the rules that we use for SNA, we deflate it with inputs rather than with its trying to describe a real value to it. So consider the coronavirus vaccines, right? The US paid, I don't know, something on the order of magnitude of $10 billion for those vaccines, but they had enormous value to the economy and to individuals. But because they were free, they're not counted as output, and they don't show up in 2021 GDP, right? Similarly, other government projects will not show up in GDP for their real value the way they would if they were private sector things. And one of the paradoxes then of advocating government sector innovation to benefit the planet or to benefit whatever is that even if they're wildly successful, as the US investment in vaccines was, it doesn't show up on the balance sheet.
Thank you. Richard, do you want, I mean, I suppose that's all obviously entirely correct, but I mean, no one, how do you feel the national account should deal with that type of issue?
Yeah. I mean, essentially, we're in a position where we're talking about a set of, across, not just vaccines, but a lot of what we've been talking about is about effectively non-rival, non-excludable goods. They're effectively public goods created by the private sector. Now, in the public sector, we look at these we look at direct measures of input, direct measures of output, and we attempt to produce quality adjustments as Tony Atkinson laid down to help us to understand there's not just the number of operations that matter, it's the number of people who survive the operations that really matters. And to some degree, that gives you two big problems. Firstly, you've got to find the right data to measure the outcome that you're going to be delivering, and that requires a little bit of foresight in some of these areas of intangibles where we don't know what the full scale of impacts will be. And you've got to have confidence in your ability to cope with the time lags between the delivery of a thing and the outcome, which necessarily will come sometime afterwards. A lot of what we've talked about at this conference over the last 2 days have been various forms of valuation methods, which are cost of production. adding up all the costs, working out the value that we ascribe to it. But within that, we need to think about necessarily the markups and the various ways to treat those sorts of things, which help us bring that into balance with a discounted flow of benefits over time. Effectively, in a perfect market, these two should equilibrate, they should come together, but we know there's good reasons why they might not in many instances, and capital markets are, not the smallest of them.
Martin.
Martin Wheel from King's College. The discussion has raised an issue in my mind, which perhaps has been covered, and if so, I'm sorry I wasn't paying enough attention, but the interface between different types of capital. No, the coronavirus vaccine is presumably, or the ideas involved in producing it are presumably intangible capital, but the state of health is something that presumably we would put in the human capital account, not in the intangible capital account. Similarly, there may be some forms of intangible capital, perhaps a lot of forms of intangible capital that are only useful when they're embodied in produced tangible capital. So how do you see that interface being managed, and how do we avoid double counting?
That's a great point, but it's not a point that, is unique to the intangible sector. You have bulldozers, which are used to produce buildings, and so they can be two different types of tangible capital, one of which is an input to the other production. So I would say the R&D to produce the coronavirus vaccine is then an input to human capital improvement, because now people are better because, their immune system knows how to fight coronavirus. And in the US, at least, we can observe huge productivity differences for being vaccinated, because if you're not, you get fired. And it's the same thing with intangible capital. You have to make sure that if they're bundled together, you're not double counting it in the market price. But it's quite possible to have one produce the other. And that's different. If they're separate assets that can be sold separately, the fact it's production process for one involves the other doesn't make it double counting.
Marshall Reinsdorf. I guess I'm an independent consultant. I'll identify myself as such. I was just thinking about, if we really care about sort of policy usefulness of our numbers, a big question is spillovers. So we spent years talking about R&D spillovers. I don't know if you remember, we had the dark matter debate on foreign investment, where there was supposedly knowledge being transferred across borders, or if Intel built a plant in your country, they transferred all this knowledge that wasn't really recorded as part of the investment. So I'm just wondering if you have any thoughts on, can we measure the degree of successful diffusion of the benefits of these non-rival intangibles? And has anybody given any thought to that?
Stian, do you want to take that?
I mean, it's clearly a really important issue in terms of the measurement of it. I mean, we would expect to see it eventually manifest itself with the production of goods and services, which will be traded. So ultimately, I guess we would pick that up in TFP if we're not seeing it elsewhere. I think what's kind of interesting is the question: well, how do we measure what's actually going on? And I think that is trickier. Some of the work some of the scientometric work that I've seen that tries to look at, for example, what's happening with particular patents, where are researchers collaborating, that feels particularly interesting to me. I'm not sure that gives you a kind of a single number in the way that you would look to put something into a national account, but it definitely allows us, for example, over time to track, for example, is university research being more adapted? Are more researcher collaborations happening kind of cross-city versus in localities? So it feels like there are quantitative things that we can say about spillovers. What I don't know, but Richard might have more ideas, is I'm not sure one can just sort of build a single, this is how much spillovers there are as a whole, other than just TFP in general.
I think it's very close to Martin's question about double counting, because I think it comes down to ownership. When you have these big spillover benefits, who owns the spillover benefits? Are they attributed to the original asset? or if someone has managed to replicate your software, used your open source software, is it now their asset? You know, we need to we're knocking on the door of some quite basic concepts, and we need to make sure our treatment of these is consistent across all classes of capital. Otherwise, we could end up in quite a bit of a mess quite quickly.
Rachel, did you want to come in here?
I will say that spillovers may not be fully unmeasurable. The global spillovers, you know, you can't measure because you have no point of comparison unless we find Martians. But if you think the spillovers of FDI are very local, say within 10 miles, you should see the price of land for building factories in around that 10 miles going way up because people know they'll benefit from this foreign expertise. And people have been doing stuff that the reason city land is at such a premium is you get these spillovers. And there are people who have numbers for here's the urban land premium, and you could just take those if you wanted to get a lower bound.
Thank you. Yeah, in the second row here. I think this will be our last question, sadly.
Hi, I'm Prashant Garg. I'm a PhD student at Imperial College. So I have a question about environment. So a lot of focus has been on reducing the carbon emissions of firms through taxes or carbon pricing, but these all are like supply side measures. What about demand side? So could firms' ability to greenwash, could that be seen as a form of an intangible capital? And if so, how do we account for, or how do we reduce that and measure that?
Who wants to take that?
Well, I'm happy to. So I'm not sure I understood the question fully, because surely greenwashing is a bad thing and therefore it's a negative aspect of creating an inefficiency in the market. So of course, this comes back to how do you even value sort of government regulations and stuff. You know, just to kind of also reflect on the previous discussion, I think any measurement kind of needs to ultimately ask, what is it for? Who's going to be using it and for what purpose? And that's where I think, you know, ultimately there are going to be very many insolvable problems, and you can really only solve the trade-off by knowing, well, who's going to be using this data and for what purpose? What do they already know and what do they need to know extra? I would, as a user, as opposed to as an academic, I would very much caution against coming up with anything that's too clever, too complicated, too sophisticated, and too conceptual, because people will misunderstand and they'll say, oh, GDP has gone up, without actually realizing that that's because we capitalized something we didn't use to capitalize, or we valued at market prices something that we didn't use to. And that those estimates of market prices by definition are extremely dodgy, because no one has a crystal ball into the future. And so what I would say is transparency, consistency, and kind of coherence are almost more important than some of the sophistication. And then we can deal with some of the issues of what's missing, what's different, what needs extra work outside of the national accounts by saying, okay, there are 5 pieces of information you need, not just one. And we haven't crammed everything into one and pretended it's all okay, because people are going to want to untangle that one thing anyway to understand what's going on underneath the bonnet.
Do you want to make sure that's first?
Okay. Can I also say that a lot of natural resource exploration is really about environmental protection. It's not that you have these evil businesses that are consciously destroying the environment. It's just they don't know what they're doing. And if you just go into a natural resource and you have no clue what you're doing, you're almost certainly going to damage something. And if you give them one easy to measure thing like a satellite picture from space, they're going to try to follow and make that satellite picture look good. And that's not necessarily going to make the firm actually be good for the environment. You have to invest real resources in measuring the natural resources to understand, you know, what the firm should be doing, and tell that to them so that they can, you know, voluntarily avoid damage.
Good. Richard, did you want to say?
My only thought was, I think, just in relation to the question, it's really important that we do manage to get a good, consistent mapping of different types of asset. You know, if we want to capture something like how a firm is changing its branding to communicate how green it is, we need to make sure that's in scope. Similarly, if we've got an intangible about training and organizational capital and we're thinking about human capital somewhere else, we need to really be clear where one ends and the other starts. So for me, it's about making sure that we think about all the jigsaw pieces simultaneously.
Lovely. Thank you very much, Richard. I wanted to say a couple of things just as we close. First of all, most importantly, is to thank the panel, to Stian, to Richard, to Rachel, and to Tera for a really stimulating hour of, I think, discussion where we've learned not only that we do obviously have to do much more research into this area, but also just how interesting and how important this sort of research is. So if we can give a big round of applause to the panel, please. And secondly, this is the end of the conference. So I wanted to thank everyone here for being here for 2 days and a very, very successful conference on a most important topic. So give yourselves a round of applause, please. And thank you very much.